Hello everyone, Clifford Bennett, Chief Economist at ACY Securities. Trading in New York on Friday saw both the bulls and the bears by the end of the day having a point of reference. The market did experience some significant selling, but then it also rallied rather strongly towards the close. So once again, that last 1 to 2 hours of trading in New York can set the tone for the market going forward. At first, US futures were a little bit hesitant in the Asian session, but they are showing some signs of wanting to test the upside again. The pattern in recent times has been the market gets sold off overall in the US, it lingers, and then there's some kind of just gentle buying in Asia. And then that gets stronger into the New York Open. And then on the New York Open, we tend to see big moves in both directions just so the major price-making institutions can stop all their clients out and make money on both sides. Oh, sorry, a little bit cynical there. But there's definitely been some stop-loss seeking algorithms at work and headline following algorithms in the New York trading session. Overall, though, what we've seen is equities give up those very strong attempts to keep making new highs over recent weeks and begin to crash back towards the bottom of what is a very strong range. Now, the market tried to sort of test the bottom of that range and has rebounded for the moment on that New York close, as I said, and is kind of uncertain through Asia. I suggest to you that the rally will occur perhaps in the New York trading session in the morning. I would think, though, we may not get quite the usual end of day New York trading strength. Could be proven wrong, but what I'm seeing or feeling is that large institutional sellers are back in the game really for the first time this year. For much this year, big institutional sellers were standing aside, those, because there's always some people who want to buy and some people want to sell. And those who wanted to sell were standing by watching to see how far will this market rally on the idea that the Fed will pivot, whether it's true or false. We've always known it was false, but not many other people did. And there's still some people out there hitting that drum, would you believe? It's very amusing. So the institutional sellers have been standing aside, but now they're coming back into the game, but they're not going to chase the market lower. So again, they'll wait to see how far the rally can come up, and then they'll do their selling. The reason they're selling is across corporate America board level, everyone is discussing the fact that there isn't going to be a Fed pivot, that the economy is weak, but it's probably not weak enough to stop the Fed raising rates. And inflation is rekindling. So it's a worst case scenario actually for the equity market outlook and for the economy going forward, because it means, okay, so we're going to have sometimes slightly positive growth, sometimes negative growth in the US economy, whether they all get strung together in the right number of quarters to say it's a recession or a depression remains to be seen. But we're going to have weak economic growth below trend probably for the next 3 years. This is why corporate America, across all different industry sectors, not just the tech sector, are laying off tens of thousands of workers. This is in an environment where it's apparently hard to find workers. So why would you get rid of your existing expertise if you thought the US economy was going to turn around anytime soon? You wouldn't. So corporate America is pretty aware that the downside for the US economy is ongoing. So in that environment, why is everyone long US stocks? I actually think the US stock market could be the weakest stock market in the world this year. Be very careful about being long US stocks. And US stocks do start to break the bottom of this range in the last few weeks. They could snowball a little bit to the downside because those institutional sellers are not wanting to chase the market lower yet. But if the market started to drop too suddenly, they would begin to push the panic sell button a little bit. At the moment, they're just sort of pushing the on offer sell button, not the panic sell button. Now, if you've never experienced a panicked market, I have. 1987, October 87 was one of my most successful trading months ever. And that's the month where the Australian stock market fell 50% in 3 days. Yes, I am not making this up. The Australian stock market fell 50% in 3 days. So I don't think that's going to happen, but I wanted to stretch your minds a little bit. If everyone is long, and there has been a lot of buying, and institutional selling is only just starting, and it's not really the people who've been buying who are stopping out yet. But if we break through the bottom of this range, we're going to see that. And you can get what I call a snowballing phenomenon, where the lower the market goes, the more stomachs that are turned out there in the long positions, and the more capitulation starts to happen, which forces ever greater capitulation, hence the snowball reference. And you have a wave of institutional selling. And you have a recognition of the economic scenario I've mapped out for the last 12 to 18 months, that the US economy is going to remain subgrowth, has a lot of long-term issues, structural issues, it's in diabolical trouble, it's a grossly mismanaged society in general, and the whole world is waking up to the idea that no, the US is not number one. In fact, the last keynote address I gave for Eurofinance annual conference in the US in Miami, I did say, as I walked to the lectern with 600 CEOs in the room from all of America's top corporations, that you will never be number one again. At that point, the room went a little bit quiet. And I got to the lectern and I said, one, you'll never be the largest economy in the world again because the European Union is already larger than the US, but no one wants to talk about that. Secondly, you're no longer the number one entrepreneurial economy in the world. China is. Because in the West, the over-regulation and over-taxation and the mature nature of the capitalist system in the West means squeezed profit margins, high costs of operation. It's a difficult job to remain entrepreneurial in that environment. There's pressures for it, but the regulation, the taxation, all those things weigh upon the entrepreneurial spirit. Whereas in Asia, China is an example, but across Asia and also South America, you still have very fat profit margins, but low regulation and low taxation. Now you can argue the rights and wrongs of that, but that's how it is. And that's why you're seeing tremendous economic growth far exceed the old West of Europe and the United States in China, Asia, and South America. Eventually, Africa will come online, but that doesn't look like happening soon. If anyone's going to talk about it, I can't believe people still talk about emerging markets referring to Asia. Really? They're the new first world. And I've said that for 10 years. Asia's the new first world, some parts of South America perhaps, and Europe, the US are the old first world, and Australia and Canada have a foot in both camps. They're old first world in many ways, but they also benefit from supplying commodities to the new first world of China, Asia. I would suggest as a global equity portfolio structure, you're going to be far better equipped this year if you're positioned in Asian equities as a defensive position against the problems that confront the United States particularly, but also Europe. Europe can continue to surprise to the upside on their equity market as they feel they fully priced in the war, or the war will not deteriorate in the Ukraine situation. But there is a lot happening that signals warning bells that things could unfortunately and very sadly degenerate in the Ukraine theatre as a result of all the different posturing that is now occurring on both sides. So, and I'm not saying either side's right or wrong. I'm just saying that both sides are pushing ever closer to a broader conflict. Will we get a broader conflict? Let's hope not. Will we get heightened risk of a broader conflict? Most probably yes, and that could spook equity markets again in Europe. So that's the caveat there. Inflation's going to remain stubbornly high. The Fed's going to continue to raise interest rates. The US has all sorts of structural economic problems, which is why property prices are falling. Equity markets are still in a bad trend overall since the start of last year. The housing industry, deep recession. The manufacturing industry, contraction. Services sector has been in contraction, just poked its head above water to be slightly expansionary on the last monthly reading, but could easily slip back into contraction. None of that is a strong economy. The US economy is not a strong economy. It hasn't been for a while. All it had was massive government spending of taxpayers' money to make everything look good, to give a whole lot of businesses a free ride, if you like. But now the chickens are coming home to roost. I hate that saying. I don't know why I just used it. Basically, there was a party and now there is a hangover and no one knows how to deal with it. So everyone's doing the just don't look this way, nothing going on here. The US economy is strong. Don't look at all the economic data series. Just focus on one, the employment number, and forget that there's 2.6 million less workers in that employment number. Forget that. Just out of the people who are actively looking, unemployment is low. So let's just think about that and say the employment market is strong. So it's a very nice sleight of hand, that one, but really, you look at all the US economic data, the US economy is still in trouble. It's going to be in trouble for quite a long time, which means why have equities had such a big rally? It was purely this notion of the only thing that determines a stock market is interest rate levels. And what will happen this year is the Fed will magically capitulate and start cutting rates aggressively to rescue the stock market when that's not its brief. Its brief is to fight inflation when necessary, to keep it in a target range, to support economic growth and maintain employment. It is not to rescue the stock market. So there won't be any pivot or anything like that, and the stock market will be allowed to decline as a natural resetting of the United States with inflation going through the roof. Workers are continuing to fall badly behind in the United States. It's becoming very much a two-tiered society, as many countries are, including Australia, where the rich have gotten very rich and the poor have actually gotten poorer. The widening wealth gap didn't bother me at all in the previous decade. In fact, I gave many a speech talking about how the wider wealth gap was not a problem, because even though the wealth gap was getting wider, the rich were getting richer, but the poor were getting richer too around the world. And we actually had globalization help create a drop in the overall global poverty rate that was quite remarkable. So the poor got a lot richer through globalization the previous decade or two. But right now, what has changed through COVID is at first everyone got a lift, but then it became only the rich who were really in the kind of asset markets that benefited from quantitative easing and near zero interest rates. For the people who were not rich, they were drawn in, for instance, by the Reserve Bank, to this idea that money would be cheap forever, and therefore they could extend on their home and buy another property, an investment property, and people who couldn't really afford buying a home did so. Sounds a lot like the GFC, doesn't it? And in fact, a lot of the economic data series have plunged back lower or just above GFC style levels. There is a lot wrong going on in the Western economies. That is why I continue to caution on the idea that you just buy stocks because they always go up. As I've said before on these shows, in 1929, if you bought stocks, you had to wait 25 years for them to get back to the same value. That's a long time to wait. Oh, and a lot of those stocks just cease to exist. It's another thing about stock markets. When people say the index always goes up, but a lot of companies disappear. So the index only has in it the companies are doing well in that time. It's not the same group of companies over this long period of time. So it's a false impression that over time all stocks go up. No, many go out of business. Many go to zero. They don't always go up. You have to play the market multi-directional. You have to protect your investment portfolio, because in the West this year, there are more problems to face, and it isn't going to be, a nice walk through the park. It's going to be heavy storms and the pathway being washed away at times. So we all need to stay on our toes, use all the financial instruments available to us to both protect our investment portfolios, play effective defense, and on occasion, play very effective attack as well. I wish you well to what's shaping up to being an even more exciting year than I had first envisaged it to be. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.